Good evening to you all, and welcome to the 7th episode of Market Replay. If you are tuning in for the first time, I'm your host, Koketso Ditlhakanyane, founder and head technical analyst at Ace Forex Academy. Just to give you a brief outline of what I seek to do with this series of videos, what I just basically want to do is highlight the different trading opportunities that were presented to us for a specific trading day belonging to a specific security, right? And how I will be then doing that is by reviewing a day's worth of price information in the form of candlesticks, right? And for today's episode, we will be looking at the US 500, which is commonly known as the S&P 500. And this is basically just a grouping of the top 500 performing shares on the Nasdaq exchange. Okay. The market data that we'll be looking at is market data for the 20th of July, which was this past Friday, right? Let's get into it. So we are first going to start off by marking the trend, right? As we can see, we opened up on a bearish candle, right? That didn't last too long. Bulls kicked in, tried to push the price up. Okay, gave us a higher low and a higher high, but that didn't last long either, and the bears then came in and kicked the market to the downside. They continued to push, giving us a lower low and a lower high, and then we had a brief moment of consolidation. Okay, right, before a continued push towards the downside by the bears, right? So we had a lower low and a lower high, lower low. Okay, another brief moment of consolidation. Let's mark that out. Okay, then we had a push to the downside. Just to give you note, these moments of consolidation will be revisited later, and I will be going into detail as to how we would have taken particular trading opportunities that were presented to us. Okay, trend changed to the upside with bulls kicking in, continuing to push the price up, but that didn't last too long, and the bears then kicked in and continued to push the price to the downside, right? Bulls kicked in again, but little strength for the bulls, right? This is me just basically understanding the story behind price, right? So price continued to push to the downside with the bears in control of the market, and price continued to go. Bulls then eventually kicked in and pushed price to the upside. Okay, you can see the formation of higher lows and higher highs. Price was continually pushed to the upside. The steam behind the bulls then ran out, right, and price was then kicked to the downside. But let's see how long the bears managed to maintain this. Okay, not very long. Price was then changed back to the upside, right, with the bulls being in control of the market. And then we had a brief moment of consolidation, right? Okay, so we can see, and price continued to be pushed up, right? And we're given another brief moment of consolidation, okay, where the bulls were then gathering steam to continue to push price to the upside, right? As you can see, we had a break to the upside. Price continued to go up, right? Bears tried to kick in, right, but couldn't hold the market for too long. Okay, and the bulls then kicked in and pushed price back to the upside. Right, following that push to the upside, had another moment of consolidation, right? Have a look. Okay, Then we had a breakout to the upside with the formation of higher highs and higher lows, high lows, high high. Okay, price was pushed to the upside. Brief moment of consolidation, right? And price kept on going higher, right? And that's how our day would have ended for the Friday. Okay, as we can see, we had a very good trading day with some good selling opportunities and some good buying opportunities, right? Okay, now let's just have a deeper understanding of these consolidation zones, right? And then we'll be going back into them and understanding them. Okay, let's start with this first consolidation zone that we have over here, and let's mark that out. And let's move on to a lower time frame to understand, right? To clearly zoom out, and let's find it. Okay, like I always say, right, we like to start on the left. Okay, understand our history before we then move on into the future and try and forecast it, right? So over there we had the formation of a swing low, and the swing low then gave us our area of support, right? And remember that our area of support represents our area of demand. Okay, it indicates that there are a lot of buyers parked within this particular region, right? And with that being the case, we then pull out our modified Fibonacci tool and we forecast this entire swing to the downside, right? And based on our strategy, we are only interested in pullbacks that exceed the 50% level, right? And we can see we had that particular close above the 50% level with this bullish candlestick that we have over here, right? And with that information in mind, that then indicated to us that we needed a close below this low before we could take a sell position to the downside, right? Let's then forecast our possible take profit targets and our stop loss placement. With this bearish candle providing us our confirmation that we need, okay, we can then have an understanding of whether we would have taken this trade or not, right? So based on our strategy, right, we strive to make a minimum of 1:1, which is represented by the 100%, right? And then we can further then hold our position or our partial open positions past the 1:2 mark, right? So having a look at this particular scenario, what we can then see is that our 100%, which is the 1:1 risk reward ratio, right, which represent a 1:1 return, right, far exceeded our area of demand or our level of support, right? And because that exceeds our area of support, we would have not taken this particular sell to the downside, because what this indicates to us is that because we have this barrier here in the form of an area of demand, we have two possible outcomes. Number one, price can come in and continue to push to the downside. Price can go, sellers then lose the battle and buyers kick in and push the market back to the upside, right? So because history indicates that price turns at this particular level and our minimum profit target far exceeds the turning point, would have not taken this particular trade, right? Even though it then went to the downside, that's part of trading, right? Nobody is 100% certain, but you can at least try to get a higher probability when you trade. Okay, that's how we would have dealt with this particular setup. We can move on to the next one. This is our next setup. Let's zoom in. Okay, let me just remove this over here. Right, Okay, let's just pull out our Fibonacci tool to try and understand a kind of retracement. So we forecast in this entire move to the downside. Okay, and what we can already see from here is that we had a pretty shallow pullback, right? So we would have not been interested in this particular setup, right? Because we want pullbacks that are way beyond the 50% level, right? And that's so that we could give our minimum risk reward ratio some room to have a possibility of playing out, right? But when we are too close to our area of support, which is drawn in over here from the highest time frame, we do not have a good risk reward profit forecast, right? So yet again, this presented a selling opportunity, but upon further inspection we can see that this was not a tradable opportunity. Okay, let's move on to the next one, which is this particular position we have over here, right? Let's move lower. Okay, like I always say, we start on our left before we move right, and what we have in this case is a swing to the upside, right, which gave us a swing high, and that allowed us to forecast our area of resistance, right? Meaning that we have a area of supply over here, right? This tells us that sellers are parked in this particular region over here. So to your mind, what's supposed to come is the possible outcomes that you can get from this interacting with this particular zone, right? Number one, price can come from the buyer's perspective and they could lose power in this particular region, and price can turn and then head back to the downside, or buyers can still maintain strength and push further up, right? And with that in mind, we then pull out our Fibonacci tool, forecast this entire move, and what we are interested in is a pullback way below the 50% level. And we can see with the close of this bearish candlestick, we are then cleared, or we are then given the go ahead to take a particular position, which is a buy in this case, right? And what this then indicated to us is we needed a close above that high over there, right? And pulling out our Fibonacci yet again to forecast our possible TPs, what we can then see from taking this particular position is that our minimum risk reward ratio, okay, which is the 100% level, right, sits well below our zone, right? This is it here. It sits well below our zone, right? And our other risk reward ratio that we aim to hit, which is 1:2, sits within our zone, right? So with this particular trade, you're looking at making a more than 1:2 risk reward ratio, right? Because you can see our 100% was well attainable. It was well below our turning point, right? And our 200 set right in our turning point, but with the protection of a positive stop, would have seen a return that is far greater than 1:2. So this was a very good buying opportunity of the S&P 500 for the Friday, right? And that's how we would have taken this particular opportunity. Okay, let's move on to the next one. And that was this opportunity right over here. Okay, let's move on lower and get an understanding. Just clearing up the chart, right? Same procedure, nothing changes. We start on our left before we go to our right hand side, right? So starting on our left, we have the formation of a swing high. And what does the swing high give us? It gives us our area of resistance, right? This is our area of resistance. Okay, now with the area of resistance, what do we then know? This area of resistance represents our area of supply, meaning that sellers are parked within this particular region, right? And as sellers are parked within this particular region, it then tells you that price has a probability or has a chance of becoming expensive to buy, and people may start selling, right? And any buyers that were in the market are trying to exit because people are forecasting that that may be an expensive enough price to take profits, right? That's how buyers lose the fight in the market, and that's how sellers then enter the market to try and push price to the downside, right? Remember that sellers are your suppliers in the market, right? And I always give this example. Imagine yourself running a store, right? You, as the supplier of the good that people are demanding, wants to make the most profit. You are not going to sell it at a cheap price, right? You're going to sell it at a markup, at a very expensive price. And that's what our area of supply indicates, right? Those who have the CFDs that people want to buy are then looking at selling them at this particular point, because they assume that based on history, this might be a very expensive level to sell at. Okay, and with that in mind, what we can then further see is, upon inspection of this particular opportunity, we have the classic fake out pattern over there, right? And we hold these positions with high regard, right? So with the classic fake out position, we were looking at price to close back on the inside of our supply zone drawn in on our highest time frame, which is represented by this yellow line over here, right? So pulling out our Fibonacci to understand our possible forecasts, we can then see that with a very conservative stop loss, our minimum risk reward ratio that we are aiming for, which is 1:1, sits far below our zone, right? And the other one that we are aiming for, which is 1:2, is beyond our zone, right? So with an entry after the close of this candle over here, we can see that 1:1 was well attained, right? As well as 1:2. Now having a positive stop after 1:1 was attained would have seen you walk away with a more than 1:2 risk reward ratio, probably looking at 1:5 to around 1:8, right? This was a particularly good trade to take, very rewarding, very good risk reward return on this particular trade, and very safe, right? Because we had a clear stop loss that was marked out by the completion of this fake out move that we had from the side of the sellers trying to push price down, but they then failed and price then got pushed to the upside, right? And we would have taken this particular position like that, joining the buyers and pushing the S&P 500 price right to the upside. Okay, and that's it for this particular opportunity that we have here. Very simple trade to take, very simple steps to follow, no indicators needed. We don't overcomplicate things, right? Always try to keep things simple in the market, right? Candlesticks say a lot, you just have to know how to understand them. Okay, let's move on to the next one, which is this opportunity that we have here. Let's go lower and have a look, right? As we go lower, we start with the same process. Okay, start on your left. What do you have on your left? Swing high. What does a swing high give you? Level of resistance. What does a level of resistance then tell you? Your level of resistance tells you that, hey, trader, have a look, right? We have sellers that are sitting in this particular region. Okay, so be careful when you take this particular trade. And with that understanding, we can then move to the right hand side. And what do we then see again? Another beautiful fake out pattern, right? Simply marked, right? We have our support represented by the yellow line, which comes from the highest time frame. Bears tried to close over it but lost the battle. And then the buyers then kicked in and continued price to push price to the upside, right? So we took an entry after the close of that candle, and using our modified Fibonacci tool, this is the particular understanding we have of the profit targets, right? So using a very conservative stop loss, what we can then see is that our minimum risk reward of 1:1 sits well below our zone, and 1:2 sits above our zone, right? So taking this trade, after we hit 1:1, we then placed a positive stop, and unfortunately we were then stopped out later, right? After we had partially closed some positions over here, because it came back and it hit our positive stop, but then price then continued to move to the upside. You would have been safe in this particular case if you had not used a positive stop, right? Just maintain your stop loss and you would have seen a return that far exceeds 1:8 or 1:7, right? Because price then skyrocketed from this particular position and went to the upside. And that's how simply we would have taken this particular trade, not overcomplicating it, keeping things very simple, and just using an understanding of price, okay, and following what the candlesticks are trying to help us understand, right? Let's move on to the next one. It's this last opportunity that we have over here. Let's have a look. Right, like we always do, we like to start on our left and go to our right hand side, right? Start on our left, have a swing high over there. It's a pretty messy one, but let's have a forecast and let's understand. Okay, swing high then gave us our level of resistance or our area of supply. Right, pulling out our modified Fibonacci tool, what we can then see in this particular zone is that we have a close well below our 50% level, right? And with a close below our 50% level, that then indicates to us that we are looking at taking a buy position, right? And we have a pullback that is sufficient enough to then join the particular position, right? So with that understanding in mind, we were looking at having a close above that high. But what we have that's particularly interesting is that, as you can see, our close is well above our resistance zone or our area of supply. So we would have not taken this particular trade because it does not meet our requirements, right? We do not have some breathing room between our entry and our possible turning point. We are closing at the turning point. So that means that we do not know after this whether price is going to turn or whether price is going to continue to the upside. And based on that, we would have not taken this particular trade, right? Let's go back to our highest time frame. So that's the basic way we would have traded the particular opportunities that were presented to us by the S&P 500. As we can see, we had a very bearish start right in the early hours of the morning with two possible sell positions, but upon inspection of those sell positions, we can then see that they were not tradable positions, well, in accordance to the Ace Forex Academy specific candlestick momentum pullback trading strategy, right? However, after the 9:30 mark on the clock, what we then see is a handsome dishing out of buying opportunities of the S&P 500, right? As we can see, price then skyrocketed up and gave us good buying opportunities, and we have seen that it's a good, we had how many, 1 2 3 4, a good 3 out of 4 would have worked out in our favor using our particular strategy, right? And that's how we would have basically traded the S&P 500 on a Friday, and that's how we would have then capitalized with those basic opportunities, right? Ladies and gentlemen, if you liked the video, please do like it. If you liked the video and you found it to be very informative and very educational, please do like it on YouTube. And then if you have not subscribed, please go ahead and hit the subscribe button. And if you want me to review a particular currency pair or an alternative security later, please do drop that in the comment section and I will have a look at that in the next episode of Market Replay. To further add on, after you have hit the subscribe button, or if you have already subscribed, make sure to hit the bell notification icon, and that's just simply so that you can be notified every time I upload another video onto the channel. Ladies and gentlemen, thank you so much for tuning in. I'll catch you on the next one. Cheers.